Hello friends, I am Sushil. Welcome to my channel Stock Wizard. Let us today analyze the company name Kotak Mahindra Bank Limited. Everyone knows Kotak Mahindra Bank as just another private bank. But what if I told you it's quietly building an empire across the entire financial sector? It is not just a bank, it's a diversified financial service group offering a range of services that include retail and corporate banking, investment banking, stock broking, vehicle finance, asset management, life and general insurance. Now here's what makes Kotak stand out. It ranked fourth in India when it comes to both deposits and gross advances. Its security broking arm commands an impressive 11.8% market share as of financial year 2024, and the asset management business already capturing 6.5% market share. In short, Kotak Mahindra Bank is not just growing as a bank but also building a strong ecosystem across financial services. With a solid brand, growing customer base, and diversified revenue stream, it's a player you simply cannot ignore in the Indian banking and finance space. Now let's quickly look at fundamentals of the company. The stock is up with strong sales and profit growth, but with debt crossing rupees 5.9 lakh crore, is this really the right time to buy? Stay tuned as we break down whether it's a buy, hold or avoid. The company is currently trading at 1972, giving it a market cap of nearly 3.92 lakh crore. However, its intrinsic value is 1385 and the industry fair value stands at 1201, which means the stock looks overvalued compared to fundamentals. Valuation matrix confirms this. The P/E ratio is 20.5, higher than the industry average of 12.5. The price to book value is 2.49, also much above the industry 1.37, showing that the market is paying a premium for this stock. But the red flag is that with borrowings of 5.9 lakh crore, the company's debt to equity ratio is 3.76 and debt to EBITDA stands at 10.2. This highlights high financial leverage and risk. On the brighter side, performance has been impressive. Operating profit grew at a massive 76.6%, while sales have compounded at 24.8% CAGR over the last 3 years. The PEG ratio of 0.92 also indicates growth is somewhat justifying the valuations. The return ratios are mixed. ROE at 15.4% is healthy, but ROCE at just 8.17% shows debt is pulling efficiency down. Plus, an EV to EBITDA of 17.4 suggests the stock is trading expensive compared to the earning capacity. What finally we can understand is that the company has strong growth and profitability, but it is highly leveraged and trading at a premium. For fresh investors, it is better to wait for a little correction. Existing investors may continue to hold cautiously, but keep an eye on debt level. The choice is yours. Let's take a look at the company's profit and loss performance over the last decade. Back in 2014, the company reported revenues of just 11,986 crore. Fast forward to 2025, 12 months trailing, revenues have grown nearly 6 times to 67,080 crore. This shows consistent top line expansion year after year. But here's the twist. Along with the rising revenues, interest cost also shot up. From rupees 6,300 crore in 2014, interest expenses have climbed to almost 29,000 crore in 2025. That heavy debt burden has kept financing profit negative all these years, with financing margins staying in the red between minus 12% to minus 30%. Now, what really saves the company is its other income. Over the years, this segment has ballooned from rupees 5,282 crore in 2014 to 37,624 crore in 2025. This is the 12-month trailing. This steady income cushion has played a crucial role in supporting the profitability. Despite high expenses and interest outgo, the company has managed to deliver consistent profit before tax growth. From 3,695 crore in 2014, profit before tax surged to almost 29,000 crore in 2025, showing strong resilience. Net profit tells the same story. From 2,527 crore in 2014, it has grown more than 7 times, reaching 19,150 crore in the latest trailing 12 months. EPS has also climbed steadily, moving from rupees 16 per share in 2014 to nearly rupees 96 per share today. However, dividend payout remains low at around 2%, suggesting the company prefers reinvesting earnings rather than distributing them to shareholders. Just to summarize quickly, over the past decade, the company has delivered strong revenue and profit growth, supported heavily by other income streams. But the rising interest costs and negative financing margin remains the biggest challenge. For investors, it's a story of robust earning momentum balanced against high leverage risk. Let's look at the shareholding pattern of this company. Promoter holding has been stable around 25.9% from 2022 till 2025. This means promoters are not increasing or decreasing their stake. The biggest change comes from foreign institutional investors. Their stake has dropped sharply from over 40% in 2022 to just 32.3% in June 2025. This shows foreign investors have been booking profits or reducing exposure. On the other hand, domestic institutional investors have been increasing their holdings strongly. From around 20% in 2022, DI now holds nearly 29.6% in June 2025. This indicates Indian institutions are showing strong confidence in the company. Public shareholding has stayed steady between 12 to 13% with a slight decline in the latest quarter. In short, FFIs are reducing, DIs are buying, promoters are stable, and the public shareholding is constant. This shift shows that domestic institutions are becoming the backbone of this stock. Let's analyze the technicals of Kotak Mahindra Bank. I have taken a 5-day chart and drawn support and resistance trend lines for better understanding. The stock is currently trading around rupees 1972. Recently, we saw mutual fund bulk buying at rupees 1941 on 10 September 2025, which shows institutional confidence. This level of rupees 1940 is acting as a strong support zone. Technically, the stock has formed a long-term breakout above the falling trend line, and now it is holding above the line. The key support levels are at rupees 1943 and rupees 1843. If the price stays above this level, the trend remains positive. Below rupees 1843, weakness may return. On the upside, resistance is visible at rupees 2200 and then the recent high of rupees 2301. If the stock crosses and sustains above 2200, we may see the momentum pushing it towards a new high. Volume activity also shows strong accumulation phase whenever the price dips near support, which means the buyers are active at lower levels. To summarize for now, the view is positive with caution. Fresh investors can look to buy near 1940-1950 levels, keeping a stop loss at around 1843. For existing investors, it's a hold as long as the stock stays above the support. If it breaks below 1843, then one should book profits or exit. This is Sushil signing off. This video is for educational purpose only and is not a financial advice. It should not be considered as financial or investment advice. Do your own research before investing. If you found this video useful, please do like, subscribe and share. Thank you once again.